guys, this is Zach Davis here. Looking forward to today. We're meeting with a good buddy of mine, Andrew Watson, a local lender here in the area. And he's just gonna go through the ins and outs and break down what it takes to buy a home in this market. Real estate can seem overwhelming at times, but if you understand a few key principles, you'll make smarter and better decisions with your money. So you're looking to buy a home in this market. That process could be overwhelming, especially understanding the loan side of it. That's why I'm excited today to meet with Andrew Watson from Summit, a local lender here in the area, a wealth of information. So Andrew, I appreciate you being here.
Thanks, Zach. I appreciate it.
So one of the things that I hear and see a lot of, and you can get a lot more into this, is every time they announce some sort of Fed rate cut or hike or whatever it is on the news or social media, my phone starts blowing up and people start thinking that mortgage rates are coming down. And that may or may not be the case. So, speak into that a little bit for us.
Yeah, absolutely. That's a great question. That's probably whether I'm walking in the grocery store and someone sees my name badge, everyone asks, hey, I saw that the rates went down, or the Federal Reserve or the U.S. Central Bank cut the interest rates. So what does that mean for my mortgage rate, right? So that's the number one question. That's the secret sauce. There's a distinct difference between the Federal Reserve rate and mortgage rates, right? Federal Reserve, kind of in a nutshell, is basically the money that is being traded or lended to banks. It's kind of an overnight rate that is going to have the government control to help control with inflation, different things that are going on in the economy. But you'll directly see that on the consumer side through consumer loans with autos, with home equity lines of credit, things of that nature. Mortgage rates are more investor-backed. Okay? And so what that would mean is they do follow or take input from what that Federal Reserve rate is doing, but they rely more on things such as bonds and economic data. And some of that economic data comes from the Federal Reserve.
So then how would you say, if somebody sees that news essentially, and they're wondering, I wonder if rates will come down or not, or, what would you recommend that they look towards? Or
So that's a great question. So what I tell a lot of my clients is to focus on a couple key terms and use our favorite search engine, right? Google, and get on there and look at what the 10-year Treasury is doing. Mortgage rates really, really follow that 10-year Treasury bond. And what that is in definition is the money that an investor is lending to the U.S. government and looking for a return on, all right? And they get that return in 10 years. Okay, so if we take a look at that data and see if that rate is moving up or down, that'll give you good indicators on what your mortgage interest rates are going to be doing over the next couple days, months, weeks, years type of thing.
Gotcha. So let's say you're looking online, you look up 10-year Treasury, you want to keep track of it. If it's going up or if it's going down, what's a good indicator to go, okay, rates may or may not be going down?
Yeah, great question. So indicators are your yields on those, or what those are being bought or sold or traded for. Okay. So if there is a higher yield going up on the 10-year Treasury bond, you might see interest rates start to come up. Okay. So what that means is there's more of a demand for the return of the money that they're letting the U.S. government borrow for the fact that they're making room for their income for inflationary aspects or indicators in our economy. Okay. Now, if you start to see those yields come down, okay, start going down a little bit, that means they don't need as much cushion in that profit from what they're lending on. So you might see rates either kind of stay stable or they might start decreasing because those yields are smaller. We really don't truly know what rates are going to be tomorrow or the next day. But if you're kind of like me, it's fun to follow and track and just keep informed. Even though I don't know exactly where they'll be, I generally have a good idea or predictions, but that's also what's kind of exciting.
Right. So I think with that, there seems to be a general assumption that rates will be going down in the near future. And I think a lot of that just stems from 2000 to 2020 rates were 3%, 2.5%, 4%.
Yeah.
They were low. And the fact that we've gone up, to where they're at today, I think people just assume they're going to come back down, to wherever, right? So, we don't want to assume that they're going to be coming back down. We don't want to assume they're going to go up. It's hard to know, right? But I guess, what would you say to that as far as looking into the future? Obviously, we don't want to predict anything between you and I, but, what is the outlook in your mind?
Well, I think what we're really searching for is stability in our economy, right? It seems like things are constantly changing, right? And what we saw, to your reference point of 2020 and how things changed a lot. We saw some good things out of that, some bad things, right? But I think a lot of it is inflationary and grabbing a hold of that inflationary aspect of everything from cost of goods and services all the way down to our housing prices and interest rates. So I think what we're searching for is something more stable, a little more predictable to give us all confidence of what it's going to be tomorrow, not this guessing game of pick a card or whoever straws the longest type of game, right? Now, of course, we always think what goes up must come down, but I think overall what we're looking for is some stability in that favorable median market for interest rates.
Right. Yeah. I mean, this may or may not be the case, but I know like throughout the 90s, the interest rate was pretty much the same the entire 10 years.
Right. Right.
Not that could happen now, but that it's good to know that could happen.
Mm-hmm.
It could be that we're waiting a long time.
Absolutely.
Might not be. Maybe they come down right away.
Yes.
So again, follow that 10-year treasury. Talk to people like Andrew when it comes to, what that outlook might be. I guess when it comes to interest rates, what are you seeing? Are there any pros and cons? I guess pros, as far as what is, when it comes to the rates being where they're at now, I guess, are there any pros right now?
Well, I think kind of what you're getting at is more or less of, should I wait? Should I do this now? I think it ultimately comes down to speaking with somebody like myself or a preferred lender and a realtor to figure out what your budget is and see if the affordability is there, right? A lot of people ask, when's the right time to buy? When's the right time to sell? And you and I both know it's when you're ready and when these things happen, right? There's a lot of changes that happen in life, whether your family's growing or downsizing, you get a new job in a different location, all these different things. So, I mean, ultimately, the pro, I would say right now about interest rates maybe being on the higher side would be that there's negotiations and less buyers in the pool, right? So you have more leverage per se on the buying side to get a better deal or favorable terms when you're submitting an offer or working with you, right? Some of the cons, of course, are just affordability. You might not be able to afford as expensive as a house as you would like or wish. But nonetheless, it ultimately comes down to what fits in your budget, right? I tell clients all the time, we're going to go through a full pre-approval and talk about those things, talk about rates, talk about payment, talk about budget. And a lot of times, a lot of my clients will find out just because they can buy $1 million home or $500,000 home or $300,000, whatever it may be, they might not necessarily want to spend that much, right? So just nailing down really what's going to fit for you, I think is the best way to gauge that.
Right. Yeah. I mean, I know we're seeing on the sales side of things, because rates are hovering at where they're at. Definitely a lot more negotiations, on both sides. It's definitely a lot more back and forth between the buyer and seller. Yeah. Things that we couldn't get, in 2020, 2019, 2021, when buyers were waiving their inspection and saying, we're all good. Mm-hmm. So now there's an opportunity to negotiate a little bit more, to have things paid for, to negotiate maybe your closing costs, things like that. So definitely something to know. Yeah,
and have time to think and walk it through, right? It was like in that previous market when rates are low and there's a lot of buyers in the pool, you had to make decisions fast. You had to make things quick. Things are moving really fast. Now you can take some time, talk it out, pencil out a budget, a lot more thought process behind it too.
Right. So here's another question. I know that it's easy for us to assume, but for people who don't do real estate every day or don't buy or sell a home every day, what does that mean for the borrower when rates are higher?
When rates are higher for a buyer or yourself, you're going to see that directly reflected in your affordability for monthly qualifications. So it ultimately comes down to that monthly payment.
Yeah.
Right. I would say a lot of people are focused on maybe or assess the interest that you'd pay over time, but really it's about what happens in that first 5 to 7 years. Seems to be about the length of time that most people will either stay in their first loan or possibly buy another house or refinance, right? Now, like you kind of mentioned, going back to the 90s statistics of rates didn't change for 10 years, refinancing might not always be the option, but 5 to 7 years is a good gauge of looking at where your payment sits, because that's going to be your direct reflection of today's current rate that you get into your house with of your budget.
Awesome. Anything else rates that you want to hit on or mention or anything like that?
Well, we can most definitely dive into the weeds a little bit on interest rates, but I think that's a good basis, right? Just like you said, if you want to follow the market and get more data, don't pay attention to what's directly on your headline news and social media platforms, or what you see across the news while you're making breakfast or cooking dinner, right? Do a little due diligence. Call your local lender. I'm happy to answer and field those questions. It's fun to me. I love to spread knowledge, and then also use your tools. Use Google, use the internet platforms to look up the 10-year Treasury rate and follow data as far as what the Federal Reserve is even meeting about, and what does that mean as far as the data that they use to control inflation or monitor inflation in the U.S. economy.
Awesome. So if you're wanting to buy a home and you're wanting to know which type of loan you should go with, what kind of property you want to buy. There's a lot of different options, and there's a lot of misconceptions out there on what certain loans are. And so we're here today to kind of chat about that, to shed some light on that and help give you a better understanding of what to expect and how to know which loan type is best for you. So with that, Andrew, tell us about, we know that there's, conventional, FHA, VA, there's more than that, but we want to focus on just those three today, because those are the major ones. Tell us about a little bit about conventional. Why would a buyer go conventional, and what does that mean? Go conventional.
Great question. Conventional loan type, right? Or conventional loan, or going conventional, right? You might hear that term a lot. There are three major loan types I think we should discuss and focus on today. And you nailed them, right? FHA, conventional, and VA, right? Those are the three main loan types that we use, or loan programs that we use here in this area. But they're not limited to that, right? But going conventional, or conventional loan, you may have heard the word Fannie or Freddie, right? These are two major investors, or two players that line up for a conventional loan, okay? They have their own set guidelines for rules to qualify with them. Right. Now, a conventional loan, a borrower who may look at a conventional loan may have a credit score above 620, has a down payment to qualify, but not necessarily needed to be large. So first-time home buyers and even repeat home buyers, you can have a little as a down payment of 5%, or first-time home buyers can do as little as 3% down in a conventional loan. Okay, so and then one of the biggest things that you'll have with a conventional loan is the property type is a lot more loose. So what I mean by that is you're not constricted to buying a certain type of home, right? So you may not have known this, but with loan program types, they line up a lot with not just the borrower of how they qualify, credit score, income, down payment, but also the type of property you're buying. So whether it be a manufactured home, a mobile home, a modular home, a condo, a townhome, single family, right? There's all these different types of property. Conventional covers and blankets almost all of those, but what you'll find is they have less rules and restrictions around the qualifications of the property, such as location, or how old it is, or how well built it is, or what condition it's in.
Right. Yeah, that's a great point. And for anybody to know as well, when it comes to buying, when you typically, sellers look at conventional loans sometimes a little bit differently, maybe a little bit stronger than maybe FHA, VA. Not all the time. It's not always as important, but if you're looking to win or have your offer win or look better for the seller, if you can go conventional, that's something that sellers look for.
Yeah, and that's a direct reflection of maybe some of the requirements that the lender or the loan program type, conventional Fannie, Freddie, may require out of the property. So you as a seller might want to have a conventional borrower come into play to borrow your house, so you don't have to do any replacement of items on the house, such as bringing something up to their standards. And it could be a number of different things, but a lot of it relates to overall just condition and longevity for the property's sake, right? Like making sure that there's no rotten boards or wood and the paint's up to code and different things like that.
You may have mentioned this a little bit too, but I think something that I always would get confused is, you can go conventional, but everybody talks about mortgage insurance and how to that. Do you avoid that with any type of conventional loan, whether you're putting 3% down, 5% down, 10 or 20, or is there a certain amount down you have to put in order to avoid mortgage insurance?
Yeah, great question. And I think that's a misconception a lot, is that people think that you actually have to have 20% down in order to use a conventional loan, which I just mentioned previously. You can go as low as 3%. Now, 20% is the benchmark to not have to carry mortgage insurance or a monthly mortgage insurance premium cost into your monthly payment. Okay. So when you would write your check, or nobody writes checks anymore, right? It's more like online, you click to pay, right?
Yeah.
That total monthly mortgage payment would include your monthly mortgage insurance premium in a conventional loan if you did not put 20% down or more. Okay. Now, of course, you can put 50% down, 80% down, 99% down, whatever your heart desires. But after that 20% down, or we call it an 80% loan to value, meaning your loan is 80% or less to the value of the house, you don't have to carry that mortgage insurance premium because you are offsetting a lot of the risk for the lender.
Got it.
Okay. Now, as you move down in the brackets, right? 15% down, 10% down, 5% down, 3% down, right? They all have their own buckets, right? As you get closer to 20%, that mortgage insurance premium is less costly, right? It's just going to come at a lower premium.
So if you go conventional and you're doing a 3% down, you're still going to have to pay some sort of mortgage insurance.
Yes. Yep. Absolutely. Yep.
I think, as far as conventional, there's also obviously FHA.
Yeah.
Why would somebody, want to go FHA, or why would they go FHA in comparison to conventional? I think one thing that I get a lot is the FHA, that people tend to think that stands for some sort of first-time homebuyer loan.
Right. Yeah.
And I think we need to clear that up. Essentially, there's not necessarily a first-time homebuyer loan. Maybe in different administrations, maybe in different types of times there have been, but there isn't technically a first-time homebuyer. And FHA doesn't mean first-time homebuyer loan. Now, there's probably a lot of benefits it has for people that are buying for the first time.
Yeah. Yeah.
So anyway, so tell us about FHA and why somebody would go. What are the benefits of FHA?
Yeah, that's a great point. Just kind of play on that. I get that call all the time. Hey, I heard there's an FHA, first time home buyer loan. And I said, well, what does the A stand for? And they're like, First Time Home Buyer Association. I'm like, oh, that's close, right? So yeah, right. So FHA, Federal Housing Administration. Okay. These are government-backed loans, as we call it. And what's unique about them is they provide lending options to borrowers that leverage different parts of the approval and qualification to help assist somebody get into the housing market, right? So I would say we use FHA loans even if you're a well-qualified borrower all the time. It just is about using the correct program for the type of property, the type of borrower you are, and maybe aligning with what the seller needs.
Yeah.
Right.
The thing about FHA that I think is easy to get confused, for people to get confused, is, you can put as little as 3.5% down, but you don't have to.
Yeah.
You could also put 20% down.
Correct.
At least as my understanding.
Yeah. So let me bulletize just some of the FHA stuff that I talk about. So minimum down payment would be 3.5%. And that is regardless of how many times you've bought. So you could be a first time home buyer, second home, third home, fourth home. Okay. Minimum credit score could be as low as 520. But I would say typically 580 is your starting qualification to get an FHA loan. And then being that it's government backed, Federal Housing Administration, they actually assist with the interest rates. Okay. So in comparison, your conventional loans are investor backed by Fannie, Freddie. FHA, Federal Housing Administration, is backed by the government. And what they're helping do is helping get borrowers or buyers into the field to qualify to move inventory and buy homes. So what they do is they help subsidize or help, with the interest rate. So if you were a highly qualified conventional borrower and a highly qualified FHA borrower, compared side to side, the interest rate might be a little more favorable in an FHA loan, right? Mm-hmm. And then the last piece to that bullet is the property type. We talked about that in conventional loans, how they might be a little more loose. They're pretty blanketed around all property types that they accept, very minimal requirements, where FHA is a little more strict, right? They're giving you the benefit of the interest rate. So they're helping out with the interest rate there. They're helping out with the down payment. Now, what that means is they want to be feeling a little warm and safe in the property that you're buying. And what I always classify FHA property types is we want to make sure that they're up to health and safety standards.
Yep.
Okay. So just living conditions, heat sources in all rooms, making sure nothing's molding or has issues, right? Stuff that most of the time our borrowers would really appreciate to have looked after anyways.
Yep. Peeling paint.
Yeah. Peeling paint, that's a big one.
Seen those. But a simple way to put that into context is if you're, I know a lot of people who haven't bought a home before, they qualify for FHA and they come to me and they say, well, yeah, I want to go, can you send me these foreclosure homes, or can we look at these type, and key to know is you really can't do fixer-uppers.
Correct.
FHA. Now there might be other ones we could get into at a different time, but but that's kind of the key to know is, it's not that you can't get a home that has some dings and dents on it,
right?
But if you're looking to flip a home or you're looking to renovate a home substantially, it's not what an FHA loan is.
Yeah, that might not be the right loan for that borrower, right?
Is there any sort of like income limit, or what would disqualify somebody from not being able to utilize FHA?
As far as income limits, or not necessarily on income limits. Now, with different types of programs, like I said, there are a lot more out there than what we're just covering today. But more or less, you're going to deal with loan limits. All right. Mm-hmm. So in a conventional world, your loan limit's going to be around $800,000 right now. Now they change every year. So you can look them up. You can look up what a conventional loan limit is using our internet friend, right? It'll tell you exactly, but they increase each year to account for inflation, right?
Yep.
And then our FHA loan limits are going to be just north of $500,000 as of 2025. So
got it. Well, that's another key thing to remember as well. When it comes to, we've gone over conventional, we've gone over FHA a little bit.
Yep.
And then there's also the third major one, and that's VA.
Yeah.
So obviously there's a specific group of buyers that can do VA.
Yeah.
So kind of just give us the rundown on VA.
Yeah, VA is fantastic. It's obviously there to serve our veterans and or active service, past service, spouses, widows. But this qualification of a loan is fantastic. It is also another government-backed loan. But the catch and thing that everybody sees about these that are so fantastic is you can do 100% financing. So it means you could do a loan, you could purchase a home with as little as $0 down.
It doesn't mean you have to put $0 down.
Correct.
But it's pretty cool to know that you can.
Yeah. And if you wanted to put 1% down to get to a payment, you can. If you want to do 2, right? But the idea is to help keep cash in the borrower's pocket and obtain a home purchase.
And that still comes with the similar benefits to FHA with lower interest rate.
Yeah.
Correct? Or
Okay. Absolutely. So to summarize and bullet that one, just like we've done the other 3, down payment as little as 0%. Okay. Credit scores, they accept really anything across the board. Obviously, as you get a lower credit score, you're going to seem more risky, may not get an approval per se, but I would say favorably, you're going to be looking at that 580 and above, very similar to FHA. And then the last piece would be kind of interest rates and property type. So interest rates, they are going to be very similar to that FHA. They're giving that advantage or that benefit to the veteran that's using this loan program. And property type is going to follow very similar to those FHA. They want to make sure that veteran's being taken care of as well, that their house is up to code and health and safety, right? I can't say that enough. That's the biggest thing is they just want to make sure it's health, safety, and sanitary for the borrower to live in.
Yep. Right? So similar thing there. It's not necessarily a fixer-upper or buying a foreclosure type of loan. Mm-hmm. Not that you can't buy something that has some dings and dents. So similar to FHA.
Absolutely.
What is the loan limit on VA?
There isn't necessarily a loan limit.
I think that's a pretty cool thing with VA is it appears to be not as much of a limit. Mm-hmm. So definitely a unique loan. Definitely all are great options. So yeah, thank you for sharing more about that.
Yeah, absolutely. And I just wanted to add in something else too. So 2 things we didn't talk about that I think are important on both of those government-backed loans is that mortgage insurance, like we discussed with conventional. Okay. So in the conventional world, we know that 20% down or more, you don't have to carry that mortgage insurance premium monthly into your payment. Okay. FHA and VA is a different style. So FHA, regardless of your down payment, you're going to have that monthly mortgage insurance. Okay. So that's going to be built in there. Whether you do put 20% down with an FHA loan or 30% down, you would still carry that monthly mortgage insurance premium in your payment. Okay. The benefit of the VA loan on top of zero down is there is no monthly mortgage insurance, even with having 0% down.
Wow.
Yeah, that is pretty cool. So you get
Really cool.
two major benefits there, and that really relates, like we were talking about how interest rates affect your monthly payment the most. Well, not having a mortgage insurance premium built into your payment and doing zero down can really help your qualification.
Wow. That's good to know. Really, really awesome. And anything else around loan types or anything like that you could share with us?
I think that covers you know, a good bulk of it, right?
Okay.
We can always dive in more. And one of the best things, like we opened with, is Zach says, sit down together, talk about these programs, to dive in deep for which one might fit your specific needs.
Yeah.
And then we can get into the weeds on those.
Well, that brings up a good point before, that really just reiterates the importance of, before you go looking at homes, before you take off and just want to try to make offers or just have a random agent make offers for you, it's really key to meet with your agent and then, meet with the lender you choose to go with, and really go over your loan and what you can do and can't do. One of the number one things I see is that where people just jump in and they tend to not ask questions about what their loan allows them to do.
Right.
And we just jump in and they start looking at properties, or they get their heart set on a certain property.
Mm-hmm.
So all the more to meet with your agent, do a consultation, even meet with their lender. That's one of the things Andrew does really well, is having a consultation, breaking everything down, going through the numbers.
Absolutely.
Making sure you understand fully, what you need to do once you get approved.
Absolutely. Yeah.
Okay, so you're looking to buy a home. You know what type of loan you're going to get. You understand interest rates and things like that. And then we get to the topic of closing costs. So Andrew, tell us, break it down for us. What are closing costs for a buyer?
Yeah, and that's a common question or misconception I hear all the time too, right? It's, hey, I worked really hard and I saved up my down payment for my loan program that I read about, and then now you're saying I have to come in with more money. Why is that? There's just two sides of the coin, right?
Yep.
You have your down payment, which is going to satisfy your lender program requirements, which we've discussed. And then the backside, even if you're not using a mortgage to purchase a property, there are closing costs. There's fees associated with purchasing real estate, right? And so I categorize closing costs into four major categories. And those are going to be government fees, lender fees, third-party fees, and prepaids.
So what would be third-party fees? What does that mean, or what does that?
Yeah, so third-party fees can vary. And why we call them third-party is they're sources or resources that we're using outside of this transaction to help make this transaction go around.
Okay.
Right? So third-party fees can be categorized as appraisal costs.
Got it.
Right?
Got it.
We got to value the home. We got to bring in somebody outside to make sure that the house is worth what you're trying to pay it for. Right?
Got it. Got it. That makes sense.
Some other third-party fees might be credit report.
Yeah.
Right? You have to access your credit, and unfortunately, we do have to pay in order to see what we have for our credit scores, and that comes from a third-party source.
What about prepaids?
Prepaids.
What would be an example of that?
Yeah, so it is a play, and you can always remember it. It's about prepaying for things that you need. So one big prepaid item that goes into closing costs is your homeowner's insurance.
Got it.
Your homeowner's insurance policy must be active the day that you get your keys for your home. And the reason being is it's yours, the loan is real, and if something were to happen, just like we have insurance on our car, it's really important for that insurance policy to be active the day that you own it. Some other prepaids are property taxes.
Right.
So in Idaho, we collect property taxes twice a year, right? And so depending on when you purchase your home, we'll allocate how much prepaid taxes we need to collect from you to get ready for your semi-annual tax bill.
Got it. Okay. So let's say somebody's approved for a loan. Let's just say normal amount of closing costs. We're not talking about rate buy downs or anything. Just is there an average? Is there a typical amount that people pay, let's say around maybe a $500,000 purchase price?
Yeah. So I would categorize it just as a percentage. I would take a percentage of the house that you're buying, and to be conservative and to really kind of calculate your budget on your own, I would use 3%.
Okay.
3% of the home you're buying should average or be approximate to what your closing costs.
Got it.
And that's because there's a lot of variables with the prepaids and government fees, different things like that, third-party fees. It just can vary from property to property, but I think 3% is a good way to gauge that.
That's yeah. So not only if you're looking to buy a home in the future and you're saving for a down payment, it's obviously key to understand what kind of loan you're going to get. if you're saving for a down payment, of course, but you should also consider that you might have to pay 2%, 3% of that price in closing costs as well.
Yeah.
Okay, we've gone over that. What would you say right now? I think one of the pros of this market is the fact that you can either use your closing costs to buy down your interest rate. You can negotiate with the seller on them to pay for closing costs. Talk to us about some of the benefits of potentially a buyer getting their rate bought down through their closing costs.
Yeah, that's a common tool, and a lot of people preface it with, oh, you bought down your rate, or you paid points, or there's a lot of definitions out there. But ultimately, I think the answer would be very specific to each borrower, right? So if you're buying a house, what you want to do is you want to put together a strategy. Like, I can't stress that enough, and we've kind of been talking about this whole time about sitting down with both your realtor and your lender, talk about strategy, what's going to work best for you. But your fees or your origination costs or your buy downs could be included into those closing costs, okay? And that would fall under that first category that I mentioned of lender fees, right? And so there may be a lot of lender fees because you may be looking to do something like that, to buy down your interest rate to help get your payment more into a favorable budget for you, or qualify for a specific dollar amount for a house that you want to buy, right? So those can vary, but I kind of turn this back over to you. What are some ways that we can leverage or keep more money into our borrower's pocket right now that you've seen with our current market?
Yeah, that's a great question. One of the cool things, especially in this market, if we were to go back 5 years ago during COVID, that kind of thing, it was impossible to negotiate with a seller almost, right? Mm-hmm. But now we fast forward with the rates being where they are, in the market, where it is, it's
kind of slowing down a little bit, kind of thing.
It's just there's more potential to negotiate with a seller, to have them pay your closing costs. So I will preface, we're not talking about commissions to an agent, we're talking about closing costs. And so we're seeing that more and more now, where sellers sometimes, not every time, but sellers are willing to pay 3%. I even have some where they're 4% of closing costs in order for that buyer to be able to afford that home, essentially. So it's something that we would work out and use as a negotiation tool while we're negotiating with the seller.
You bring up a good point. I wanted to jump in on that. So when we talk about negotiation in this market, there's obviously a lot of different ways we can do this. One is getting a better price on the home, or two, leveraging the seller to pay for those closing costs. And I use that analogy all the time. I talk about the difference of $10,000. Okay. Now, to put that into perspective, I talk a lot about what does $10,000 do to your monthly payment, right? Now, when we're talking about mortgages, we're talking about monthly payment and budget. Every $10,000, whether it be in down payment or loan size or purchase price, right? All kind of follow each other, is about $60 to $65 a month in payment difference. Okay. So when I talk to borrowers and we talk about looking at that $500,000 house and we want to make an offer, but we want to get a good deal, so we go in at $490. Well, you probably saved yourself on your budget for a $500,000 purchase price payment by $65 by getting it for $490. I would say one of the biggest concerns or biggest asks we have right now is, how can I get into a home with as little out of pocket as possible? So leveraging and actually giving that seller that actual $500,000 for the house that they want, but asking for it on the back end out of their proceeds to pay for your closing costs. Yes, it's going to keep your payment up $65 from where you'd like to be, but that's another form of negotiation to help offset that and keep more money in their pocket.
Yeah, I mean, it could save you $10,000, $11,000, $12,000, $13,000 in upfront costs that you could use towards buying furniture. You could use towards a refrigerator. All these things, upgrades to the house, all these things. Obviously, it all adds up. And buying a home is not a cheap process by any means. So being able to use that. It's not every time, but there is a lot more opportunity now to negotiate with the seller when it comes to closing costs. Now, if you're a seller, it's key to understand that you most likely will probably have a buyer ask for you to pay their closing costs. And I think there's a misconception that that's a negative thing. But if you understand what you're going to net, it's a positive thing as long as you expect it. And in certain price points, you could get a better offer because you're helping that buyer out, and helping them get into that loan by paying their either their payment down or whatever that buyer needs. So
yeah, that's strategy.
So it's something as a seller to know too, when you go to sell and calculate that into your bottom line, that could come up in negotiation.
Yeah.
So definitely a lot we've covered, and definitely a lot we've covered today.
Yeah.
I hope that this has definitely added a lot of value to you. Andrew, if somebody has questions about a loan, what's the best way for them to reach you?
I mean, obviously text, phone call, email. We'll have my contact information here, but also just get with you.
That's right. Either call either one of us, which our contact information will be in the video below as well. Big thanks to Andrew Watson for being a part of today's episode. If you like what you saw, please leave a comment, hit the like button, subscribe. We'd love for you to see more content like this in the future.